Welcome back to another episode of the Strive for 25 podcast. And I've got an amazing guest on today from AirDNA, one of the top economists, Bram Gallagher. Thank you so much for joining our show today.
Thanks for having me on, Joel.
So if you could give our listeners a little bit of a background on who you are and what you do.
Sure, yeah. I'm an economist for AirDNA. So the path I took to get here, it started with an academic career. So I was actually a professor of economics for some years up at Middle Tennessee State University. I decided that besides, of course, the academic market being as screwy as it is, I decided also that if you really want to learn about economics, you want to get involved in the real economy. So I started looking for positions in industry in Georgia. That's my home state, and I love to be here. As great as Tennessee was, I guess too far north for me, so I had to move back. And I got connected with 𝐃𝐿𝐓 Hospitality Research, which was a small outfit that was being bought by a much larger outfit at the time, CBRE, very big commercial real estate firm. But what they wanted from us was our expertise in hotels. And we had collected enormous amounts of profit and loss statement data. And it was my job to sort of look at this data in conjunction with data that we got from Smith Travel Research about hotel performance and come up with performance forecasts for U.S. hotels in 50 different markets across the U.S. So that was a incredibly fun job. And I love the hospitality industry. I love the hoteliers. It's a fun industry to be in. My boss for the longest time was Jamie Lane, and he had been interested in the short-term rental space for a long period of time. He was on, I think, some kind of couch surfing website before there even was an Airbnb. So he was very interested in the space. One of the first people to go out there and actually start talking to the hotel industry and telling them that this is going to be a permanent fixture in the hospitality space, and we need to start paying attention to it. So he eventually got offered a position at AirDNA as the VP of Research, and he's now the chief economist as well here at AirDNA. But he's really interested in the space, and he went. And about a year afterwards, he needed an economist, so I contacted him, and it's been great fun working for him since. So that's how I got here. I've been working here since September. It's been a little bit of adjustment moving from hotels to short-term rentals, but AirDNA has got incredible amounts of data, and as an economist, that's really been a lot of fun. Looking at that, talking with new people, talking with different kinds of operators, and coming up with new forecasts.
So just right there, there's a lot to be able to dig into. But just to kind of bring our listeners back into kind of what to expect with the episode. So, we talk about saving money, which starts with a lot of times increasing income. And then once you've got money saved, being able to have choices of how to invest and invest in assets to be able to then be able to have another lane going to build potential income from those assets. And so, short-term rentals is a big hot topic, something that I've personally, in that game, and so many others are getting in the game too. And I'm going to dig into some of the trends and some of the expectations for markets and all kinds of stuff today. From an AirDNA standpoint, can you just give us a quick explanation on what AirDNA is and what it does?
Sure. Yeah, they're a data generating organization. And what I mean by that is they scrape the web constantly looking at specifically Airbnb, VRBO listings. There's some other listings. Those are our main sources, though, the ones that we use predominantly. They collect this globally and continuously. And by observing that, they're actually able to look at the rates that are being charged when a property becomes unavailable on their calendar. And from this, too, they've also got a very interesting algorithm that they co-developed with MIT that deduces using a variety of factors. I think it's 16 different factors that deduces the likelihood of it either being just taken off of the market or blocked versus actually reserved. So been a very good algorithm. So from this, they're also able to get the occupancy rates. They're able to infer pacing, the rates that are being charged. And they package this up, and the main customer, the main person who looks at our data is going to be a small operator, someone that is managing between maybe 1 and 10 properties, short-term rentals, and wants to know, for instance, what should I charge? What are my competitors doing? Are my competitors already booked? And if they are and I'm not, why is that? Being able to provide sort of comparables and comparable properties, and being able to look at performance and even suggest rates that we think are going to be able to generate occupancies that are optimal, not necessarily the highest occupancy, but the optimal occupancy. So that's an interesting idea that they're also looking at as well, right? You don't want to get 100% occupancy by leaving money on the table in the forms of too low of a rate. On the other hand, if you charge too high of a rate, you might find yourself with an empty property, and that's not good either. So that's essentially what AirDNA, that's their main business. We also talked to a couple enterprise folks as well that are looking to get into this space, but one of the big differences between hotels and short-term rentals is that short-term rentals is still dominated by small operators. The unit of operation is much smaller. It's easier to get into a short-term rental. You're just acquiring either, say, a condo or even renting an apartment, and letting it on the short-term rental market, as opposed to having to construct or buy a hotel, which, as you can imagine, is a much more daunting capital prospect.
Totally. Coming from the background of hotels and being in that business and the day-to-day planning and mapping out of operations and forecasting, and bringing that back into this short-term rental market and comparing the two different kind of lanes, past history versus what's going to happen going forward in these industries of lodging. What are your thoughts on that, just as things progress with these two different industries?
Well, I would say the main difference, looking from a forecasting perspective, they're the same demand drivers. The same things are going to be making people want to take vacations or even business trips, but the supply is radically different. So, if you want to forecast hotel supply, it's real easy. You go to a construction site. It says we're going to be opening up this Hyatt or this Marriott at this date. And then there you go. That's your supply forecast. We're going to increase supply by 140 rooms at this date. But it's not the case with short-term rentals, because we've got people coming in and out. The seasonality of the supply is much stronger. People can much more readily come into the market to capture event-based demand. So that I think is the biggest difference between the two. And one of the, I guess, when we're looking at supply, and that's been a big issue for short-term rentals, especially this last couple of years, because it does intersect with residential housing, and mortgage rates have been increasing quite a bit. Well, they've been backing off as of late, but they are much higher than they were, say, a year ago, and that has some effects on the flexibility of supply.
So just to kind of take the next question on that. So right now in 2023, we've got higher rates than what we had in 2021 for sure. 22, we saw rates go up. Supply wise, are we higher or lower in supply versus, last year or the year before?
Oh, definitely higher. Definitely higher.
Okay.
Yeah, if I may, I can paint sort of a characterized picture of the U.S. market over the last couple of years. So pandemic hits, a lot of supply goes away. People are not as comfortable having folks over to their homes. People are not traveling as much during the pandemic, particularly in large cities. So we see a lot of this supply go away. Afterwards, we go to 2021, huge pent-up demand. People want to get out. People want to get to the beach, especially, but anywhere outside is great. Small towns, rural areas, those are good too. But people definitely want to get out. At the same time, a lot of the supply is left in short-term rentals, and hotels too are also shut down. And a lot of them are finding it difficult to reopen as quickly as they would like. This leads to really incredible performance, the likes of which we haven't seen since and probably won't ever see again in 2021, right? So, if I was to look back in history, what was the occupancy in 2021? And we hit in July 77.6% occupancy, which is essentially full. That's with all the short-term rentals in the entire U.S. And short-term rental occupancy always runs a little bit lower than hotel occupancy because that supply is so flexible. It's essentially unlimited if the price is right. But that was incredible performance. We were seeing tons of money going into the space. ADRs also were very, very high as well. So big rush, lots of supply hitting the market early 2022 when mortgage rates still hadn't gone up yet. The interest rates had been cut to sort of stimulate the economy. Housing was relatively affordable. We hadn't seen the enormous run up in prices that we hadn't seen the entire enormous run up in prices at that point. Yep. So a lot of people jumped on it. We saw a big explosion of supply that happened early 2022. And you might have heard or read some stories about the Airbnb bust. I think a lot of people were under the mistaken impression that that meant that people didn't want to go to short-term rentals anymore. But that was not the case. So we saw demand continue growing throughout this period and growing very, very quickly. So, 20% year over year, 15% year over year, what was it, January of 2022? Look at that. It's 42% increase year over year for demand in that month. So, big increases in demand were going on in 2022. Even by the end of 2022, we were still seeing those 15% increases in demand. But what we also were seeing was the effects of this big supply hitting. So, 15% sounds really great until you compare it to the supply numbers of 20 to 25%. And then you start seeing your unit performance decline. So occupancies were declining. To some extent, that's okay. Occupancies are still a few points higher now than they were before the pandemic. So if we think about that, and I think they're going to remain there at a little bit higher. I think that that there is a structural shift that has happened. But that was that bust that people were talking about, is that, you weren't seeing record high performance, once in a lifetime performance like you saw in 2021. We probably won't, but that doesn't mean that people aren't interested. And it doesn't mean that the space isn't still pretty rapidly expanding and there's a lot of opportunity. One of the things that I'm excited about, we just got the full month May numbers in, and the supply is finally starting to cool down. So in 2022, when May hit, that's when it really started amping up. May, June, July, people were putting their properties on the market for that summer season to capture as much of that revenue as possible. This May, on the other hand, the supply growth it's still pretty high at 15.3% year over year. But compare that to the 20s and 25s we're seeing. It's actually the lowest supply growth that we've seen since the end of 21. So more than a year, has gone by. More than a year and a half. About a year and a half has gone by. We haven't seen year over year supply increases at this low level. And demand is still powering forward. At the same time, it's the demand nights are up 12% year over year. So we're still seeing that occupancy go down a little bit. But I think that those higher mortgage payments, and of course that big run up in prices that we saw at the same time, have really cut into the ability of supply to just kind of explode like we saw at the beginning of 2022. And that's really great news for anybody that can get in the space or that is already in the space as far as unit performance goes. So, that's in broad strokes what we've sort of been seeing in the US.
So the increase in supply along this last couple of years compared to people purchasing intentionally to put this acquired home onto the market as an Airbnb, short-term rental, and supply, Are there any? Is there any way to even measure that kind of a scenario of people new acquisitions of homes versus people? Hey, I already have this home. I'm gonna to change it from a long-term rental and turn it into a short-term rental, or like, is there any way to differentiate between someone who has the home already versus someone who acquires it to add it to the supply?
Yeah, no, that's a great question. I mean, it's really difficult to get incredible visibility into that. One of the things that we can look at is the amount of listings that remain from year to year on the market as the same listing. Now that number has increased over the last 2 years. So that is to say more the market's stickier. And as transactions become more difficult with interest rates the way they are, that has two effects, right? If you want to go and invest, it's a little bit more difficult than it was a year ago. But also, if you wanted to sell your home, you might not get the highest price that you were hoping for, because the potential buyers going to have to factor in those higher interest rates in their payment. So you might hold on to your home for those mortgage rates to go down, for the Fed to start maybe cutting rates at some point. What are you going to do with that house in the meantime, right? You don't want to just have it sitting empty. If you can generate some income off of it, you'll put it or keep it on the short-term rental market. So it does kind of cut both ways. There is a very important metric in the industry that we do keep track of, and it's a KPI that is of special interest, and that's the sort of the revenue potential, the revenue that you can generate in a particular market for a particular type of home, divided by that mortgage payment. And when that number is over one, well, that's great. You can cover your mortgage payment with the income that you're getting and still have some left over. Now, if it's less than one, you're still getting equity building up in your home, which is nice, but you're also going to have to come up with some additional funds to cover that payment. So it becomes less attractive to many people as an investment.
So you mentioned rates there shortly. Do you have any guesses or data hinting of rates changing up or down in the near future? Do you have any thoughts on? I don't want you to answer the question yet, but just, do you have a yes or no, some thoughts on it?
Oh, I'm an economist. Of course, I got thoughts on it.
Okay,
yeah.
Let's save that for a little bit later, because I want to dig into a few more things in terms of the short-term rental types. And so you had some on the AirDNA resources tab in their website. They got a lot of good articles, blogs, case studies, some press news and webinars. And one of them was breaking down kind of the different trends in hot areas for cabin rentals versus beach rentals versus your more industrial urban areas. And so those are kind of the three examples of ways that you can break down the different types of short-term rentals. But can you kind of dig into some of the different trends and things going on in those different markets?
Yeah, there's a variety of ways that we try to slice the data so that you can find the most comparable property. And one is by location type. And there's 6 really broad location types that we separate U.S. rentals in. One of is resorts that are on the beach. And what we saw with those is they performed very, very strongly, very, very quickly after the pandemic. So they were the first essentially to come back. It was the same with hotels too, right? If you had some place to stay on the beach, you were golden for a solid year. People were going to be at your place as much as possible, because you could socially distance and be outside. It was great. So they came back very, very strongly, and as a result, their growth might be a little bit less than it had been in the past. So I think this article was looking at current performance and maybe where there's still some potential left, because a lot of places have been increasing rates, have been increasing their occupancies, are operating at very high performance. So if you wanted to get into that market, you would be faced with that premium being priced in. So that's something to be aware of for say beach resorts. Another thing, mountain resorts, the cabins. We've seen enormous growth in places like Gatlinburg, and of course Breckenridge, which is very close to the AirDNA offices. as well. A lot of interest in ski in Breckenridge, not as much in Gatlinburg, but it's still a real fun town right on the Smokies. Love to vacation there as well. So yeah, that's another place that has done or another location type that has done very well. You know what we've seen post pandemic, a very big interest in leisure. Again, to caricature the market, we saw Airbnb really start up in very dense urban areas. You know, there was San Francisco, New York, you know, lots of cities. Barcelona is another one in Europe where we saw a lot of activity initially. But we've seen the biggest growth in interest since the pandemic in more leisure-oriented activities, especially those that are located away from very densely populated urban areas. So seen a huge interest in small town and rural areas. And that is continuing to increase. Of course, the resorts that I mentioned, the cabins in the mountains and lakes, and also in the beach resorts, those saw a lot of initial interest. And again, the growth potential of these might be squeezed in some cases just because they have seen so much interest and growth in the last few years. But small towns, mid-sized towns as well, those are still doing very well and are growing. There's a lot of interest in there. The urban are still trying to catch up. Some of these very densely populated urban, even suburban areas are still trying to catch up. In some cases, it's limited by regulations that have occurred in these areas. So small towns, rural areas, much less likely to have very strict short-term rental regulations. It's something, if you're looking to invest in this space, you've really got to pay attention to. Regulations can cut two ways. You know, they can prevent you from operating in a market, or they can also, you know, if you can adhere to all those regulations, they can to some extent insulate you from competition. So, you know, that is an important factor to consider too.
So backpedaling just a second, in terms of you know, cabin or mountain areas, things like that. You know, you're going to have some of your pricier areas, you know, maybe it's a Jackson Hole or Breckenridge. Do any kind of up and coming, lesser well-known areas come to mind that are, you know, up and coming, hot, that could have some growth?
You know, anything that's not Big Bear, that that one has seen just incredible, just maybe even I'm not going to go as far as the oversupply, but it's been a really big supply growth area. You know, ski is tough. You know, I think there's always interest in some of the lake resorts. We lump them together. You know, they're sort of mountain lake. But if you ask me, ski is a little bit different because it is difficult to build in some of those areas. It is difficult to grow supply in some cases. So that is something that you really got to pay attention to. But you know, there's definitely interest in vacations on the lake as well, and you know, wilderness sites even to some extent. But again, yeah, you really want to pick. For me, you really want to pick the investment that is right for you, and that is going to include certainly the revenue potential, but also those other factors like the regulation, also the comfort that you've got with a particular market. We had two pieces, two sort of that were launched like back to back. One was called the best places to invest, and the other one was the hottest markets, right? And well, we had those to differentiate between the two, because if you look at our best places to invest piece, what it does is it really lays out more of a investment formula to look at. So again, looking at the cost to move into an area versus the potential revenue that you can get, the performance of the short-term rentals in that market. So what BPTI came out with, our best place to invest piece came out with, was some places that people scratched their head at a little bit. So I think Fairbanks, Alaska was the number one. And
let me hold on for 1 second. So
yeah,
if
sure,
anybody's following along and they're on their computer typing in AirDNA, going to search for an article, which article? Like I see one that's the hottest short-term rental cities. I see ranked by you know, the differentiation between cabin, apartment, and beach homes.
Yeah, this one, I'm
Is it
sorry,
a different one?
the best place to invest is titled Best Short-Term Rental Investment Markets in 2023.
Do you have a date on that article? Is it in the blog section?
It came out in May.
Okay.
Um,
Okay. I wonder if it's press news.
no, I'm sorry, this one came out in February. The hottest markets came out in May. I
Uh,
was mistaken.
okay.
So the BPTI came out in February. We followed it up with the hottest markets.
Okay.
And again, the reason that we distinguish, I can get into the reason why we had to distinguish between the two, but the hottest short-term rental cities in the US for 2023, that one came out May 17th. And that one was to contrast to some extent the best places to invest in 2023, that one.
Okay. So let's go back to the Fairbanks, Alaska top one. So this is
Yes.
from a February 13th article, best places to invest in US vacation rentals in 2023.
Right.
And I'm looking on this map, and it's interesting in that the map is all scattered with dots on the east side, except for Alaska. So Alaska, Fairbanks, Alaska is number 1, Evansville, Indiana, number 2, Rockford, Illinois, Springfield, Illinois, Burdett, New York. So what's the logic, just in short, on this type of analysis?
So this one, we've got tons and tons of data, just reams of it. And this one was a real number crunching exercise. Essentially, we're just looking at how much does it cost to get into an area versus, what's the performance of the short-term rentals. And we wanted to see, the biggest difference between the two, the biggest performance for the least amount of money to get in there. And it came up with this list. And a lot of these, there are a bunch in the Midwest, where we've got some places where property values aren't really high. If you look in California, you're not going to find a lot of places that are real cheap to get into.
Mm-hmm.
Property values are really, really high up there. But yeah, we've got a lot of places in the Midwest. There's a location here in upstate New York, some in Maine even. So these are places that have good performance with the existing STR stock, but the property values are not sky high, and that typifies the best place to invest paper. But when a lot of people got this in February, and that's why we came out with a new paper, the hottest markets, they sort of scratched their heads because Fairbanks, Alaska, the number on paper it looks great, but how are you going to property manage your Fairbanks, Alaska if you live like I do in Atlanta, right? That's it's a tough plane ride. It's a tough commute. And a lot of these aren't out of the way places, and that's where you see property values that are low compared to the performance of places. And of course, I'd love to visit Fairbanks, Alaska. I bet it's beautiful, and I'd probably pay a lot for a short-term rental there, but it would be difficult to get out there and clean it regularly if I owned a place out there. So that's what we came out with, the hottest markets in May, which is a different methodology. So this would be the best place to invest. That's kind of a process by which you can identify places that you can invest in, right? That you can narrow in of the places that you are able to invest in, which is the best. The hottest markets is where actually have people been investing this last year. And so we've seen enormous expansion of short-term rental supply in some of these places. Primarily in southern Sunbelt cities. Phoenix is number 1. We've got several in Texas as well. Again, where there's been a lot of interest in these areas post-pandemic as well. The Sunbelt was there's a lot of people say moving out of really densely urban areas and trying to get out to where things are a little bit less dense during the pandemic. And when remote work happened also, this had a profound change on people as I can work from anywhere. I'm going to move out of where it's really expensive to live and be able to live much more cheaply and yet still have the similar income. So with those sort of factors going in, we did see a lot of interest in some of these cities. To some extent, I wouldn't Phoenix, Scottsdale, it would be tough for me to personally want to invest in there just because of the incredible supply that they've got. It's going to be really hard to compete out there. In fact, I looked at the Super Bowl this year, which was in Phoenix. It hosted, and that has been a perennial demand event for hospitality. So I've been looking at Super Bowls for a long time. I'm not a professional football fan. I follow the college leagues because I'm a graduate of UGA, go Dogs. But I always had to follow the Super Bowl because that's always a big event in hospitality. People will pay a lot of money to stay at a city during that whole week of the Super Bowl. And in Phoenix, Scottsdale, what we saw in the short-term rental market was astonishing. Something I don't think I've ever seen before, but the occupancy actually year over year was lower during the Super Bowl than it was the year prior, just because of the huge supply increase, like 60% supply increase. So even the Super Bowl couldn't increase demand enough to overcome the thousands and thousands of additional listings that had appeared over the last year. So these are certainly hot markets, not necessarily the best ones to invest in right now.
Gotcha. Okay. So on this list, you got Phoenix, then Dallas, then Houston, then St. Louis, then San Antonio. So that's the top 5 here. And any other one of these you want to maybe just give a little extra feedback on or backdrop on in terms of why or how or what?
Well, yeah, all of these cities are on here for that sort of similar reasons that a lot of people, there is a lot of interest in there in these markets. And there's 2 of them from Florida. Also, we did see a lot of interest in just hospitality in Tampa and in St. Pete, that area as well. It does have, it's got nice beaches on St. Pete. You're pretty close to Disney World, and you can go to Busch Gardens as well if you're in Tampa, which is a great theme park. So a lot of demand generation happening around there, but a lot of supply as well. So Orlando, which is sort of close by, is the biggest short-term rental market, also the biggest hotel market in the U.S. in terms of the supply. So it's certainly, those are certainly, again, hot markets. We got demand generators. There's a lot of reason for people to want to go to those markets, but on the other hand, a lot of people have gone to those markets.
So you've got these articles and data to kind of digest and absorb, and then use your own typically calculations or own typical analysis. I'm an investor. I'm looking at stuff for myself and also for clients on the mortgage side. And, I use the Rentalizer very often to project out, an address. When I look at these trends and looking at these things, I'm taking the projected rental income. And then what I do is I just take 60% of that. I'm just going to assume 40% of expenses just as a round number. And then I'm backing into, okay, what if the purchase price is 300,000 or 600,000, whatever it is, if I assume 20 or 25% down, assume an interest rate, figure out what the payment's going to be, and kind of that same barometer you were saying before of the greater or lower than 1. What was that acronym you said? What was the acronym?
We call it the yield.
The yield. Okay. So if you're net, and I'm looking at the net income, if the net income is greater than the mortgage payment,
right,
of that 60%, then okay, I'm thinking that could be a strong contender to look deeper into. When you are talking about the data, and then there's so much data, how to analyze it, how to make sense of what the numbers mean, from your perspective, from the economist side, any other insights on some of the tools or data that's out there that is more important than others?
Yeah, no, that Rentalizer is a great tool. I love that one. It's just great for prospecting. And I think we're coming out with some enhancements this fall too to that, to make it a little bit easier for people to figure out where they can invest. So, stay tuned for that. But, I would say that generally speaking, what you want to do in your mind is try to think of places that you would be willing to invest, that you know the market, that you're comfortable, that you can access these properties, that you can look after them. So for me, Fairbanks, Alaska is pretty much off the table. I live in the Atlanta area though, and I live in the western suburbs, so that kind of narrows it down. We've got a major major urban center here. I could drive there and maybe look after some properties. So, that's where I could start putting in my focus. And then from there, using the rentalizer and also looking at what the house prices are and what those potential mortgage payments might be, I might be able to really fine tune where I think I'm going to be able to get the best bang for my buck. The expenses are difficult for short-term rentals to get great data on. A lot of people do the cleaning and maintenance themselves. You should definitely figure that labor into your investment equation, because your time is very valuable as well. But yeah, you also want to try to estimate expenses, how much it's going to cost to hire a cleaning service, or how much that would be. How much is it going to cost to continue to refurnish your apartments? Because people are going to wear those towels out like you wouldn't believe, and people like fresh towels as well. So,
Right.
Go ahead and buy them in bulk. You won't regret it. But yeah, trying to figure out some of those expenses, and then again, finding the best bang for your buck. I think you're going to be able to get a pretty good picture about whether or not these investments are possible, and what they're going to look like. I think visibility into, people that are already into the space and are actually renting is great too. Having those comparables close by, to see, what is realistic.
Kind of going in a different direction. You and I were talking about this, I think previously, that Airbnb was putting some extra emphasis on just solo rooms that they're advertising and pushing more out there. Why are they doing that?
Yeah, so their summer release, they really started talking about solo rooms. In the last few years, we've seen the biggest increase in growth in larger homes. So, with multiple bedrooms, the private room is kind of, it's kind of plodded along. It hasn't seen sort of stellar growth. It's fallen, I think, as a proportion of the total rental share. So yeah, it does sort of raise the question, why did Airbnb emphasize this so much? Well, I think one of the things that we're looking at is most economists are expecting a slowdown at the end of the year, economic slowdown. We've had pretty strong jobs numbers, but with those increasing interest rates, trying to tackle inflation, with that inflation weighing on people's budgets already, I think what they're focusing on is value. So we might see private rooms as being a way to very quickly expand, supply that has a high value, because those rooms generally are less expensive than entire homes. So there's a couple things that go along with that. So one, you can also expand the supply more quickly if you can have private rooms within existing homes, because you don't need transactions. And as I said, transactions in the housing market right now, well, you're in the mortgage business. They're not white hot right now. So you can expand the supply perhaps more quickly with people carving out a room in their existing home, and putting that on the market. So from a supply side, there's that interest, but from a demand side as well, we've got this really strong jobs market. So people have got jobs, but on the other hand, we've got inflation that's pinching their budgets. They need to go on a vacation, but they can't spend as much on a vacation. Maybe this is one way to save some money.
So some more options, having that person that wants to be able to get out, but have some more effective, cheaper options, essentially.
Yeah, and it might end up too being just something that draws you into the website, that says, wow, I could stay for $65 a night in this private room. That's incredible. And then you're looking and said, you know what? But also I could have a whole house to myself for another 40 or 50 bucks a night. And that's worth it too. So I think, just from an attraction standpoint, because people are going to be looking towards, budget conscious options, is a way to attract people into the space that might not have considered it otherwise. Just as an alternative to traditional hotel lodging.
So now the all important question that I know that I want to hear your opinion on in terms of rates, and I'm sure other people out there are interested too. But you mentioned that some economists, expecting the economy to slow down. Inflation is still there, pinching into budgets, as you mentioned. Jobs are still strong. What the heck's going to happen? What's going to happen with as we go through the rest of this year?
So yeah, we like to we partner with Oxford Economics and look at their forecasts, very frequently. They've got kind of a tourism focus, and we've got long-standing relationships with a lot of the folks over there. I just finished up with the Outlook report. We're hoping to publish it next week, and that sort of synthesizes our economic outlook with what we expect performance in the short-term rental industry to look like over the past year. We had done another one of these outlooks at the beginning of the year, and a big miss, something that we didn't get right, was the economics. And Oxford Economics didn't get it right. Most people didn't get it right. They're expecting a downturn, and they're expecting it to hit jobs pretty hard. So we didn't see that, right? Job growth has continued. In fact, the gap between where we expected the total employment to be and where it actually is amounts to about 4 million jobs, which is, incredible. As an economist, I'm very impressed. This is the lowest unemployment rate we've had in decades and decades.
I'm sorry. Can you explain that number again? So 4 million jobs. What is that number again?
Yeah, that's total U.S. employment. So just the total number of jobs.
Oxford that are available to hire, or that's jobs added, or
people that are working, people that are filling these occupations, that are pulling in paychecks, and therefore that need vacations. I mean, so okay. 4 million, that's a huge number, right? So total employment, about 154 million people, 155 million people, or jobs, I should say, because you can work multiple jobs. And that is about 4 million difference from what they're expecting at the beginning of the year. So huge of additional jobs. So they were expecting a retraction, expecting an economic slowdown. It didn't materialize as expected.
Why? There's all this doom and gloom that I see on the media about housing prices going down, this happening, that happening.
Yeah, it's a great question.
Why is that different? Why is that not happening?
It is a great question. I think there's a lot of explanations, none of them necessarily satisfactory, but we have seen more employment. Maybe one of the reasons for this is there are sort of more service sector jobs, and there's still a long way to go in that recovery. So as a service-oriented economy, when construction and manufacturing slow down, we don't lose as many employed positions as we once did. So that might be one thing. Another thing is that inflation has been increasing faster than wages. So in some previous inflationary periods, wages have gone up with inflation, or even maybe have been ahead of inflation a little bit. This is the cause of the wage inflation spiral that they were really dreading. We haven't actually seen that materialize. So to some extent, maybe it's not as expensive to hire and to retain employees as it may have been in some past inflationary periods, compared to what you can sell your output for. So some of all these sorts of things, they might be contributing here and there to higher employment. And it looks like that even though Oxford is now expecting the downturn to happen in the second half of this year, that even still we are going to still see stronger employment than they had predicted 6 months ago for the foreseeable future. So that has been a characteristic of this economic business cycle, that is to some extent unfamiliar. We've never seen a recession occur when everybody has a job.
Unfamiliar is probably the best way to put it. We're in uncharted territory, right? I mean, maybe not, but like the pumping of money into the economy from the pandemic, rates going to all-time lows, and then the rapid increase. We saw some of these things happen in different cycles. 81, for example, the rapid increase in rates.
Yeah, but it wasn't this rapid. So this is, I believe, the most rapid increase that we've ever seen. And some of that, maybe the world just operates more quickly nowadays with all the telecommunications that we've, improvements that we've seen. The internet was invented and all that sort of stuff. People can bank online and can, transactions just happen that much more quickly. So maybe that's why we had to raise those rates quickly. But in any case, yeah, it's like you said, we don't have a great historical precedent to compare this to. But one thing I do know is that if you do have a job, you need to take a vacation every once in a while. So that's a constant. So as a result, I think we had to revise our demand quite a bit upwards.
So from a CPI standpoint, CPI has been falling each month from a rolling 12-month average from I think last July it was like 9.2 or 3, and then this most recent reading from April's data would put it just under 5%, depending on which metric look at. So it's continuing to come down. What do you expect, or what does Oxford say about that in relation to their projecting for some type of downturn? How does that all fit together in terms of timing?
Yeah, we're going to see some inflation numbers coming out pretty soon. The markets are betting, as you said, on continuing reduction in inflation rates, so slowing of inflation. There's been a lot of talk about, what is it? It's a narrow path to avoid recession, but also to tame inflation. Looking for that soft landing, I guess. That's the cliche that's been thrown around a lot. So the Fed is going to be. Historically, the Fed has not been good at soft landings. Historically, the Fed tightens too much, and we do have recessions. Whether it's different this time around because of our incredible momentum in the labor force and in our employment, we might be able to achieve that this time. I'm expecting because just because everything is just turning out better than we thought it was, I'm expecting the Fed to raise rates maybe one more time. Some people say no, they're going to keep them as they are. There's going to be a pause. And I think that's more of the mainstream view, is that there's going to be a significant pause, and we're going to take stock, another 6 months from now, whether or not we want to lower or raise rates or some time frame like that. But in any case, we're either close to the top of the rates as far as the Fed goes, or right before the top of the rates. So they should at least not go up a whole lot more than they are. Mortgage rates have been falling a little bit here and there, I think, in anticipation of this pause and maybe even reductions that the Fed is going to do. So you might start to see that actually translate into the real economy closer to the end of the year, which would run contrary to the idea that we're going to be having a downturn. That's going to be, something that could in fact increase growth. So I think a lot of questions remain.
So March's monthly CPI was around 0.1, April higher at 0.4 range. Given the data you are seeing, or what would you guess May's numbers to be, higher or lower than April of a 0.4?
Oh God, well we're hoping that the year over year growth drops below 5. I mean that is very important. If it doesn't, then we're going to see some more rate increases. So that's going to be a number that people are paying very, very close attention to. Because we want to. Right now, the inflation rate has been declining, and it's been doing so in a roughly symmetrical way to its increase. So, we want to see that continue, and any deviation from that, either on the downside or the upside, could influence Fed decisions. So I'm going to be paying attention. I want it to come in and say 4.5 or 4.6 or something like that. That would be nice. But if it's 5.1, then yeah, we're going to see some more. We're going to see some more action from the Fed. It would be my bet.
Okay. And then that data gets released next week, maybe? Or when does that data get released? I forget.
Oh, let me check the my colleague Jamie Lane. He likes to go to the BLS website and click refresh over and over and over again until the new data gets there. But my professors always told me you gotta distance yourself from the single data point. You just check on it every once in a while. So I'm looking at the release schedule. Let's see. Now I release schedules for news releases. It is coming out pretty soon. Productivity Employment Consumer Price Index, Tuesday the 13th. So yeah, early next.
Okay. Yeah, because I know you and I were talking about this before too, that like whether they calculate the 12-month rolling index, and one thing that I said over and over that is just really interesting is that the run up last year of CPI from April, I think it was like around 0.5. May was a 1 point, just under 1% for the individual month, and then June was 1.2 for that individual month, and then July just fell off a cliff. It was 0, 1.2 to 0 all of a sudden, and like I felt that in my industry in terms of mortgages because we had a good closing month in June, but the applications, like the new business that was coming in the door, was like fell off a cliff that month as rates went from the mid 5s to the mid 6s within a few weeks, and then so July's data to show a 0, like it doesn't surprise me because I felt it, but like to see that data, that massive drop off was just very interesting, especially looking in hindsight. And then when May and June fall off that 12-month rolling average, that's going to help that CPI number come down even further as we get further into the summer. Is kind of what I'm seeing. Is that what are your thoughts on that?
Yeah, and I think a big part of that is that when we look at the components that made up inflation, housing made up a very significant portion of it this time around. So, it wasn't, inflation sort of lumps everything together into one number, but, not everything changed prices in the same way. And housing, I think, went up, significantly more than the inflation rate. So it made up a large portion of that inflation. And so, once you put the crimp on housing via the interest rates, then the prices of housing started falling a bit, and that immediately reversed course as far as inflation goes because it made up such a significant portion.
Gotcha. So end of the year, let's just say this. What's your prediction for seeing a sub 3, close to 2 CPI? Not going to hold you to it. What's your best range of guess?
Yeah, I'm thinking that we stay above 3 for the rest of the year.
Okay.
And then we get back to more like 2.5. There have been talks too about maybe the Fed needs to increase its target from 2 to 2.5 in this new world, because the 2% target is to some extent an artificial construction, and yet it determines so much actual stuff that happens in the real economy. But yeah, I still see that there's a tremendous amount of strength in the economy. So, a downturn such as it is, it's probably not going to feel the same as it has. And something else to think about too is when we think about recession and downturns, I'm thinking about, 2008, 2009, which was like the greatest recession since the Great Depression in 1932. And then there's the COVID, which the entire world shut down for 6 months. And so now when we're talking about a downturn, it's not nearly on that scale. And plus, you're also probably going to have a job this time around because the way the labor market looks. You've got a lot of old folks retiring as well, getting out of the labor force, and they're switching from savers to spenders. So there's going to be some demand that's going to come out from that as well. And it may not even feel like a downturn the way that we've been conditioned to expect.
All right, now we're up against time here. Last couple of things. Is there a data metric? We've been talking about CPI and the economy in general. Is there a data metric that you like to look at that gives you hints or insights of things to come that may not always be talked about?
Absolutely. Yeah. Something new in this outlook report is we really started to look at short-term rental pacing. So that is one look at least one category of expenditure that's going to happen in the future. And what we're seeing is that vacations this year are going to be really strong. So, whether or not there's a downturn, we're going to see some significant growth in leisure and hospitality. That's been a segment that has been trying to recover since the pandemic. We're still getting there in some areas. We've achieved and surpassed pre-pandemic levels in other areas. But yeah, that's one sort of way that we can look at the future, is to look at what's already on the books. So this summer, we're pacing 10% ahead of where we were this time last year. We're expecting for the entire year of 2023 to be up to 10.4% as far as demand goes. So that's going to be one of our headline numbers that's coming out in the outlook. That's a positive story. Because
that's amazing.
We had record demand for short-term rentals last year. We're gonna be beating that again this year. Is there going to be a little bit more interest on finding the best deal? Maybe. Our ADR prediction is going to be around 2.1%, which again is probably below what I said inflation was going to be, but it's still positive. It's a little bit less than, it's quite a bit less than last year, which in 2022 we saw 5.7% rate increases. We're expecting 2.1, and some of that might be the mix as well. I should point that out. This ADR figure is not corrected for mix. We're looking into ways to do that. But if we have a lot more private rooms being rented, for example, that will drag our average down. So unit performance might be better than that. But yeah, I think it's a really positive sign. I think given it gives a picture of people's confidence in the labor market for the future. Not only do they have a job now, they're expecting to have it this summer when they're taking that vacation.
Yeah. I was going to say, kind of going back to the idea of a soft landing, what does that even mean? And, it'll be very interesting to see as we kind of progress through the rest of this year and look at the expenditure, GDP, employment rates, stock market, all these things. And obviously hindsight's always 2020, but to me, there seems like a shot at a quote unquote soft landing. If certain things continue to line up here, they've got a shot, which is just remarkable given the just dramatic swings of markets in the last couple of years.
Yeah, absolutely. And, as an economist, people always ask, like, are we in a recession, or, are we headed for a recession? And the old joke is, the economists, we always say, well, do you have a job? And if the answer is yes, then no, we're doing fine. If the answer is no, then we're definitely in a recession. And I think the answer to that question has been for most of this year, and will continue to be for most people, that yes, we do have a job. And that is going to make this, if there is a downturn, it will look quite a bit different, feel a lot different than we have in the past. And maybe you're right, there is a chance that we could see an upside to this, or demand continues expanding, investment begins to pick up, and we avoid it, even the small downturn that we're expecting.
Yep. Well, I just want to say thank you so much for making time for us and the audience here to take a little bit deeper on the short-term rental market, the tools that AirDNA has, and the broader economy in general. And looking forward to catching back up down the road. And we'll be watching some of these metrics as we progress through the year. And Bram, can't thank you enough.
Well, thanks so much for having me, Joel. It's been a real fun time.
All right. Take care. Talk soon.
Bye.